So also, if you look at Vedanta's past, in 2012, there was merger of Sesa Goa, in which Anil Agarwal had 55% stake, and Sterlite Industries, in which Anil Agarwal had 58% stake. And through merger of this Sesa Goa and Sterlite Industries, they formed Sesa Sterlite. All right. And there was opinion or allegations that this was a strategy to dump 5.9 million rupees debt and the struggling aluminium assets into the Indian balance sheet of the merged entity Sesa Sterlite. And coming back to Vedanta Resources, it was delisted in 2018 and it transferred stakes to Kane India and Vedanta Aluminium and Madras Aluminium to Sesa Sterlite. Now this, it was alleged, or there was opinion that this conveniently transferred substantial amount of Vedanta Resources liability into the profitable merged entity. So looking at history, it is likely that Vedanta would repeat such criteria after the merger. Another very important point that we need to discuss is Vedanta Resources, the parent company, was delisted in 2018. Similarly, Mr. Anil Agarwal wanted to delist Vedanta Limited in 2020 at a price of rupees 87.5 per share. But they didn't have enough funds, or they were not able to, or they were not willing to pay higher prices that was put up. Okay, the prices were very high, and therefore they were not able to buy back the minority shares, and therefore the delisting could not be proceeded with. Now, why Mr. Agarwal wanted to delist in 2020? What could be the possible reasons? One, the share price was very cheap at that point. Second, the dividend that it has to pay, around 45% dividends it has to pay to the remaining shareholders, that can be curbed and that can be taken to reduce debts or to finance operations or to use elsewhere, right? Third, there could be better control and flexibility over operations and finances. Fourth, Vedanta has more than 63% stake in Hindustan Zinc. So the profits or the cash flows that it makes out of it, or the dividends that it has to distribute, that can be curbed than to share cash flows and profits and dividends of Hindustan Zinc with the remaining 36-37% shareholders. Why not keep it within the group and utilize it as needed to reduce debts or to finance operations or whatever capacity expansions or whatever it is, right? Why to share with the minority shareholders? That could have been a criteria. Probably this demerger plan could be an extension of the proposed delisting plan. What could not materialize by not being able to delist, the objective can be to materialize it by demerging. Okay, by perhaps making it different entities and to declare debt-laden entities as insolvent or something like that, and to pass on the burden to lenders and creditors and regulatory bodies, right? So what is the risk? So on the face of it, how it looks is that Vedanta Resources, the parent, is utilizing Vedanta Limited, Indian subsidiary, to reduce its debts, to finance its operations, etc., in the form of dividend, in the form of brand fees, etc. And there is frequent stake sales, there is frequent raising of funds, and there is frequent borrowings. And the reason that they give is they want to reduce debt. They want to reduce debt is the reason that they're giving. So if we look at data only for the past 5 years, if you see, Hindustan Zinc's borrowings have increased by 10,350 crore rupees. That is from 611 crores. It has become to 10,964 crore rupees increased borrowings in the past 5 years only. And Vedanta Limited's net debt, if you're going to see, that has increased by around 32,000 crores. That is from 21,273 crores in 2020 to 53,251 crores in 2025. In this 5-year period, net debt has increased by 32,000 crores of Vedanta Limited, the Indian subsidiary, and Hindustan Zinc's borrowings have increased by a massive 10,350 crore rupees. All right. Vedanta Group wanting to delist in 2020, intention as it looks like, it could have avoided paying dividends to the remaining shareholders. Cash flows and profits whatsoever generated could have been utilized for its own use, and it could have avoided paying dividends to 45% stakeholders of Vedanta Limited and 36-37% stakeholders of Hindustan Zinc, and that it can use that money for reducing debts, better cost control, and servicing holding companies' operations. Okay, so risk in the current scenario is that long-term debt of Vedanta Limited has doubled in the past 10 years. Cash and cash equivalents have almost come to 50% in the past 10 years. Long-term debt has doubled. It has become 200% of what it was in the past 10 years, and cash equivalents have become 50% of what it was in the past 10 years. And the company is going on selling stakes frequently as well as borrowing debts, and they're massively paying dividends, and such dividends are not funded out of the company's cash flows or profits, but mostly out of borrowings, because when you don't have so much profits and cash flows, where else will you pay your dividends from, right? So in case in the future Vedanta says that it does not have enough funds to repay loans, the parties that would be affected by this statement would be the creditors, the lenders, the financial institutions, and the investors at large. According to a report in 2023, if you see, Indian banking institutions have a rupee loan exposure of $6.73 billion in Vedanta Group's total gross debt of $15.3 billion. So out of the total gross debt of $15.3 billion, Indian banking institutions have a rupee loan exposure of $6.73 billion, which this $6.73 billion comes to roughly around 59,000 crore rupees. So I've not been able to get exact loan exposure of Indian banking institutions to Vedanta Group in 2025, but roughly it should be around 50,000 crore rupees or more than that. 50,000 crore rupees loan exposure. And in case Vedanta says they don't have funds to repay debt, it would become, in case it declares itself or it is declared insolvent, the whole of this 50,000 crore rupees is passed on to the lenders, to the investors, to the creditors, and eventually to common people, right? Such serious allegations have been made, and management cannot just go about treating it as a normal affair, as a normal course of things, right? So even when ED asked as to why you're paying such abnormal brand fees, they decided to refund 1,030 crore rupees without disclosing it to shareholders, just like that, like normal course of operations. You need to mention, right, this was refunded because of so and so reasons. Company didn't feel the necessity to do so. It kept shareholders and the public in the dark, and therefore all these course of allegations cannot be treated as a normal routine thing. You cannot just say the existing numbers were specific, select numbers were picked and sensationalized to make profits. There are serious allegations, and there are reasons and rationale for the allegations that have been made, especially why do you have to pay so much dividends, and that too out of borrowing? Why such dividends when you're not making enough cash flows and profits? Why are you having to sell your stakes frequently? Where does funding for capex comes from? So all this is something management has to answer. The management, if at all, if it comes out and says that we have so much capacity expansions in place, business expansions in place, we are investing in it, this is the source of the funds for capacity expansion, and the said capacity expansions will materialize or will fructify in so and so years and this will be so and so amount, and that such that debt exposure will not be an issue. It will be taken care of. And if Vedanta's management is able to substantiate such claims that so much capacity expansions are going to yield so much returns in so and so future and so amounts, only if it is able to substantiate it will some amount of trust be placed on the company and the management that things look sustainable in the long run. So that's it for this video. So subscribe for more such detailed videos.